There's a rule sitting quietly in federal law that touches nearly every retiree's bank account at some point. And most people only find out about it the moment they're standing at the teller window wondering why a simple deposit suddenly requires extra paperwork. It's not a secret the IRS is hiding, and it's not some new surveillance program aimed at older Americans specifically. It's a law that's been on the books since 1970, and it applies to everyone equally, but it tends to catch seniors off guard more than most, simply because retirement often involves exactly the kind of large one-time cash moments this rule was built around. The rule itself comes from something called the Bank Secrecy Act, and the number at the center of it is $10,000. Anytime someone deposits or withdraws $10,000 or more in cash, the bank is legally required to file a report with the federal government, known as a currency transaction report. This isn't optional for the bank, and it isn't a judgment call based on how the teller feels about the transaction. It's an automatic requirement that kicks in the moment that $10,000 threshold gets crossed, whether the money came from selling a car, cashing out a CD, receiving an inheritance, or simply consolidating cash that's been sitting in a safe at home for years. A retiree who sells a paid-off car for $12,000 in cash and walks into the bank to deposit it isn't doing anything wrong, and nothing about that deposit suggests criminal activity. The report still gets filed automatically because the law doesn't distinguish between someone with a perfectly innocent reason for a large cash transaction and someone who might not be. The currency transaction report simply documents that the money moved, who moved it, and roughly where it came from, and in the vast majority of cases, it sits in a federal database and nothing further ever happens because of it. Where this gets genuinely important for seniors is a separate piece of the same law called structuring, and it's the part most people have never heard of at all. Structuring means deliberately breaking up a large cash transaction into smaller pieces specifically to stay under that $10,000 reporting threshold, and it is itself a federal crime, regardless of whether the underlying money is completely legitimate. A retiree who deposits $4,000 on Monday, $4,000 on Wednesday, and $4,000 the following Monday, thinking they're avoiding paperwork rather than avoiding scrutiny, can actually trigger a more serious investigation than simply depositing the full $12,000 all at once would have. This catches people specifically because the instinct feels protective rather than suspicious. Someone who's heard vague rumors about the IRS watching large deposits sometimes assumes the safest move is to keep each individual transaction small, never realizing that the pattern of repeated near-threshold deposits is exactly what banks are trained to flag as potential structuring. Banks use automated systems specifically designed to notice deposits clustering just under $10,000, and those systems don't care whether the money came from a legitimate source like a home sale or an inheritance. The safer approach, when someone has a genuinely large, legitimate amount of cash to deposit, is simply to deposit it as one transaction and let the bank file its routine report, rather than trying to manage around the threshold at all. It's worth understanding what actually happens after that report gets filed, since the uncertainty around this is often worse than the reality. In the overwhelming majority of cases, a currency transaction report goes into a federal database and is never looked at again by anyone, because nothing about a single large, well-documented deposit from a legitimate source raises any flags worth pursuing. The report exists primarily to help authorities trace patterns tied to money laundering, drug trafficking, or other criminal activity at scale, not to single out an individual retiree who sold a car or received a wedding gift from a relative. Being transparent with the bank about where a large sum of money came from, if asked, tends to resolve any momentary friction almost immediately. There's a related piece of this that seniors specifically run into more than younger account holders, simply because of how retirement finances tend to work. Cashing out a CD, closing an old savings bond, or consolidating accounts after a spouse passes away can all generate sums well above $10,000 in a single transaction. And these aren't suspicious events. They're just normal parts of managing money later in life. Knowing in advance that crossing this threshold triggers an automatic, routine report can prevent the moment of alarm that happens when a bank employee mentions paperwork that sounds more serious than it actually is. The same threshold applies to withdrawals, not just deposits, which surprises people who assume the rule only watches money coming in. A retiree withdrawing $10,000 or more in cash for whatever reason triggers the identical reporting requirement as a deposit of the same size. This matters for anyone planning to keep a larger amount of cash at home, perhaps out of a general distrust of banks or a desire for accessible emergency funds, since pulling that much out in one visit generates the same automatic paperwork as putting it in. What ties all of this together is how ordinary the underlying mechanism actually is, despite how alarming it can sound the first time someone encounters it. This isn't a rule that targets retirees, and it isn't evidence of increased scrutiny aimed at any particular group. It's a decades-old law that applies uniformly to every bank customer in the country, and the only people who run into real legal trouble under it are the small number who try to dodge the threshold through structuring, rather than the much larger number who simply deposit or withdraw a large legitimate sum and let the bank do its routine paperwork. If this is the first time you're hearing about this rule, you're not alone, since most people go their entire lives without crossing that $10,000 threshold in cash often enough to ever notice the reporting requirement exists. The one thing worth remembering above everything else is this: if a large cash transaction is ever necessary, handle it as a single, complete transaction and be straightforward with the bank about where the money came from, rather than splitting it into smaller pieces in an attempt to stay invisible. That single habit is the difference between a routine report that goes nowhere and the kind of unwanted attention that structuring can actually create. Let us know in the comments if this is the first time you've heard about the $10,000 reporting threshold, or if you've already run into it yourself with a deposit or withdrawal. And if this cleared up something that's been sitting in the back of your mind, subscribing means the next one of these reaches you before a surprise at the teller window catches you off guard.